Cibus Nordic Real Estate AB occupies a highly specialized and structurally defensive niche within the European real estate landscape, focusing exclusively on properties anchored by grocery and daily goods stores. This strategic orientation is deliberate, designed to capitalize on the non-cyclical nature of necessity-based consumption, providing inherent insulation against macroeconomic volatility and secular threats posed by e-commerce. This stable foundation of recurring rental income is the core enabler of the company's stated goal, providing shareholders a favorable, stable monthly dividend. The third quarter of 2025 demonstrated exceptional operational momentum and execution capability. The company reported substantial growth in core earnings metrics driven by accretive acquisitions across new markets, specifically Norway and Belgium. Rental income and net operating income, NOI, both recorded a robust 38% year-on-year surge, while the key metric, profit from property management, PFP management, rose a dramatic 54% in the quarter, reaching Euros 21.8 million. The investment thesis is centered on Cibus's unique combination of stable underlying assets and highly optimized financial engineering. The company has effectively mitigated immediate interest rate risk through a defensive capital structure, achieving a 95% hedging ratio on its debt. However, this strength is counterbalanced by a persistent, aggressive leverage profile, evidenced by a net loan-to-value ratio of 56.1% and a forward-looking net debt to EBITDA of 9.7 times. Given the significant operational performance and the sophisticated mitigation of financial risk, the investment thesis relays on the ongoing scrutiny surrounding the company's reliance on a concentrated tenant base and the necessity of high-quality execution to manage its elevated debt load. 1.2 Key drivers and structural risks for the outlook. The current market valuation of Cibus, which sees shares trading at a premium price-to-earnings multiple relative to the Swedish sector average, is not sustained merely by recent performance, but is overwhelmingly a market bet on future operational transformation. Analysts widely project a dramatic improvement in future profitability, forecasting that profit margins will surge from an approximate 24.1% today to 58.1% within 3 years. This near tripling of earnings efficiency, underpinned by robust rental indexation and accretive portfolio optimization, forms the primary conviction behind the consensus buy rating and the projected 20% potential upside. The ability to capitalize on index-linked leases and stable rental growth is perceived as anchoring future stability. However, the structural risks require disciplined investor vigilance. The high leverage profile, while currently accretive due to favorable financing terms, presents heightened financial risk. The high net LTV and net debt to EBITDA ratios are cited as constraints that limit flexibility and place the sustainability of the monthly dividend under ongoing scrutiny. Furthermore, despite extensive geographic spread across 7 countries, the overwhelming concentration of income within a handful of dominant retailers, particularly the 34% reliance on Kesko, means the financial health of the group remains highly sensitive to the creditworthiness and operational stability of its anchor tenants. The investment thesis requires the company to successfully execute its portfolio growth strategy to gradually dilute this critical concentration risk, while simultaneously delivering on the aggressive margin expansion expectations that are currently baked into the share price. II, Corporate Strategy and Portfolio Foundation. 2.1 The Grocery Anchored Imperative, Resilience in Retail. Cibus has established its business model around the acquisition, development, and management of high-quality retail properties strategically located across Europe, primarily characterized by having essential grocery retail chains as anchor tenants. This focus on the grocery and daily goods sector is not merely opportunistic. It represents a core imperative for resilience in modern commercial real estate. This sector is distinguished by its necessity-based nature, which fundamentally insulates rental income from the typical cyclical economic downturns that plague general, office, and cyclical logistics sectors. Moreover, the portfolio exhibits strong resistance to the secular pressures of e-commerce. While online shopping is growing rapidly in the Nordics, with 83% of Nordic consumers shopping online in the last 30 days as of Q2 2025, grocery-anchored properties often serve as crucial strategic distribution and delivery hubs for online traded goods. This dual utility, serving both physical daily shopping needs and acting as vital fulfillment points, ensures the long-term functional necessity of the asset class. The overall portfolio scale is significant, encompassing approximately 650 properties across 7 countries, with a total property value recorded at Euros 2.5 billion. 2.2. Geographic diversification, Nordic core with Benelux expansion. Cibus touts extensive geographic diversification across the Nordic region and the Benelux region. However, a detailed examination of the portfolio reveals that the risk exposure is not evenly distributed. As of the financial quarter ended 31 March 2025, the group owned 491 properties in the Nordics. Finland is the dominant single market, accounting for 262 properties, which contributes approximately 50% of the company's income. Sweden follows with 133 properties, Denmark with 73, and Norway with 23 properties. The balance of the portfolio is situated in the Benelux region, comprising 149 properties, heavily concentrated in Belgium, 131 properties, with smaller representations in the Netherlands, 17 properties, and Luxembourg, 1 property. While the acquisition of new assets in markets like Norway and the consolidation of the OnePlus joint venture in Belgium serve to broaden the footprint and deploy recent capital, the portfolio's center of gravity remains highly exposed to macroeconomic factors specific to the Finnish economy. This concentration means that while the company benefits from the general strength and safe haven status of the Nordic real estate market, localized downturns or shifts in supply and demand within Finland could disproportionately affect the group's valuation and profitability. 2.3. Operational stability metrics. The operational metrics reflect stability and effective property management. The occupancy rate demonstrated improvement, rising to 96.1% in Q3 2025. This high rate is supported by active new lettings and the strategic acquisition of assets with inherently high occupancy profiles. Furthermore, the weighted average unexpired lease term, WALT, stands at a solid 5.8 years, providing long-term predictability and visibility on rental income streams. The portfolio stability, characterized by a WALT that remains stable at 5 years in Q1 2025, is critical for underwriting the high leverage structure. Management has emphasized active asset management as a core driver of portfolio quality and cash flow optimization. This includes ongoing redevelopment projects, particularly within the Finnish segment, and a continuous process of targeted divestments to streamline the asset base. These efforts contribute to the company's continuous growth in earnings per share. The resilience of the portfolio performance, even in the face of localized valuation headwinds observed in Finland, is evidence that the operational strength is successfully absorbing minor market volatility. 3.1. Income Statement Deep Dive Q3 2025 Focus. The financial results for the third quarter of 2025 underscore the success of Cibus's aggressive expansion strategy. The income growth was directly attributable to the rapid deployment of capital raised through a June equity issuance, which was swiftly allocated to accretive acquisitions, particularly in the Belgian and Norwegian markets. For Q3 2025, rental income reached 42.0 million euros, representing a substantial increase from 30.4 million euros recorded in Q3 2024. Net operating income, NOI, mirrored this upward trajectory, totaling 40.2 million euros compared to 29.2 million euros in the prior year period. This uniform 38% year-on-year surge in both key revenue metrics indicates strong operational efficiency with minimal corresponding increase in direct property expenses. The cumulative performance for the first 9 months of 2025 also reflects this robust growth, with rental income reaching 122.4 million euros, up from 91.4 million in the same period of 2024. The most striking performance metric was the profit from property management, which surged 54% year-on-year to 21.8 million euros in Q3 2025. This performance not only reflects portfolio expansion, but also benefits significantly from decreased financing costs, which have been effectively managed through the company's hedging strategy. Earnings after tax for the period amounted to 19.4 million, a sharp reversal from the negative 5.6 million reported in Q3 2024. 3.2. Earnings capacity and portfolio valuation. The consistent operational success is formalized in the earnings capacity per share, which rose to 1.07. This metric has increased for the 9th consecutive quarter, demonstrating an 8% year-on-year and 2% quarter-on-quarter increase. This sustained growth confirms management's ability to consistently source and execute accretive deals, optimize rental indexation, and successfully lower the company's cost of capital. The EPRA net reinstatement value (NRV) per share reflects this sustained financial improvement, increasing over the preceding 12 months to 12.9 euros per share as of Q3 2025. While operational profits have been strong, portfolio valuation stability was tested in the quarter. Unrealized changes in property value resulted in a minor negative adjustment of 2.9 million euros in Q3 2025, which is notable lower than the negative 6.4 million reported in the prior year. This minor adjustment was primarily attributed to updated valuation assumptions applied by external valuers in the Finnish market. The ability of the company's surging operational income, 54% PFP management growth, to comfortably absorb this localized valuation pressure highlights the robust nature of its cash flow generation model. 3.3. Transformative margin expansion forecast. The consensus amongst analysts is that Cibus is on the precipice of a significant transformation in earnings efficiency. The investment community is anticipating an extraordinary surge in profitability, projecting that profit margins will dramatically expand from the current 24.1% to a striking 58.1% within the next 3 years. This forecast margin expansion serves as the central justification for the stock's current premium valuation. The basis for this ambitious projection rests on 2 pillars. Firstly, the ongoing strategic focus on the highest quality grocery-anchored assets ensures stable, non-cyclical rental income. Secondly, the proactive investment in ESG standards and operational efficiencies is expected to drive more favorable, lower-cost financing and streamline property management expenses. The most recent earnings report, showing a substantial reduction in financing costs and robust NOI growth, confirms that Cibus is executing in a manner that aligns with this aggressive analyst consensus. Investors are therefore purchasing shares at a premium PE multiple today, effectively pricing in the assumption that this exponential growth in operating leverage and profitability will materialize in the near term. IV. Capital structure, leverage, and debt management. 4.1. Leverage profile assessment. Cibus operates with a high leverage profile, a common characteristic among REITs pursuing aggressive growth strategies through acquisition. As of Q3 2025, the net loan-to-value ratio, LTV, stood at 56.1%. 4. Management noted that the temporary reduction in LTV observed at the end of Q3 was due to the funds raised in June that were not yet fully deployed into acquisitions, and the ratio is anticipated to increase back toward the higher levels seen in Q1 2025 as the capital is allocated. Financial prudence metrics reveal continued high indebtedness. The interest coverage ratio, ICR, improved to 2.4 times, indicating debt service coverage is adequate but leaves limited operational headroom. More critically, the net debt to EBITDA ratio was reported at 10.7 times. Management prefers to emphasize the forward-looking ratio, which stood at 9.7 times. Ratios consistently above 9 times are scrutinized by analysts, who identify high leverage as a potential constraint on the company's ability to sustain or significantly increase its dividend over the long term. 4.2. Advanced interest rate risk mitigation. Despite the high leverage, Cibus has implemented a highly defensive and sophisticated capital management strategy. The company is currently 95% hedged, providing substantial protection against rising market rates. This hedging ratio is planned to increase further to 97% in the fourth quarter. The average cost of debt has decreased, with the average interest rate dropping below 4% to 3.9%. This favorable cost structure is facilitated by the low-risk perception of the underlying assets, which has led to bank margins reaching an all-time low of 1.4%. This superior access to capital is a direct function of the stable, necessity-based cash flows guaranteed by credit-worthy grocery tenants. Crucially, the hedging strategy incorporates interest rate caps, which results in a highly favorable asymmetric sensitivity profile. If market interest rates were to rise by 1 percentage point, the estimated negative impact on annual earnings would be marginal, amounting to only 0.6 million euros. Conversely, if market rates were to fall by 1 percentage point, the company would realize a positive impact of 4 million euros annually. This structure maximizes downside protection while retaining significant upside exposure should global monetary policy ease in the future. 4.3. Capital maturity and liquidity. The company maintains healthy access to both bank and bond markets, evidenced by the successful issuance of a 20 million euro tranche of senior unsecured green notes in October 2025. Management also reports increasing competition among lenders to finance these high-quality assets, further enhancing Cibus's negotiating leverage for future debt refinancing. As of Q3 2025, the average capital maturity of the debt was 2 years, with the average fixed interest maturity slightly longer at 2 years. This maturity profile, combined with the high hedging ratio, suggests that Cibus has effectively insulated its immediate financial performance from short-term market fluctuations, although ongoing refinancing requirements necessitate continued favorable market access. V. Risk assessment and mitigation. 5.1. Critical tenant concentration risk. The most significant operational risk facing Cibus is the substantial concentration of its rental income among a limited number of major tenants. As documented in the 2023 annual report, the largest tenant, Kesko, accounts for 34% of net operating income. This is followed by Tokmanni at 19% and Coop Sweden at 12%. The collective reliance on these few dominant grocery retailers renders the portfolio highly susceptible to the credit default or operational distress of any one tenant. Analytical findings confirm that a concentrated tenant base is generally associated with increased liquidity risk and is known to impose limits on a REIT's potential for sustained dividend growth. For Cibus, a major operational or financial setback at Kesko would have an immediate and dramatic impact on the group's cash flow, far outweighing risks from other segments. The primary mitigation strategy relies on the high credit quality of these anchor tenants and the defensive nature of the grocery business they operate. Furthermore, the company's ongoing portfolio expansion into new markets, such as the strategic acquisitions in Norway and the consolidation of assets in Belgium, serves as the fundamental mechanism by which management aims to gradually diversify the income stream away from the current high concentrations. 5.2. Geographic macroeconomic exposure. While Cibus is geographically diversified across 7 countries, the overwhelming property and income concentration in Finland exposes the group disproportionately to Finnish macroeconomic performance. The real estate market in the Nordics generally remains strong, attracting capital as a safe haven. However, the property market dynamics, including supply, demand, and yield levels, vary significantly between regions. The slight negative unrealized change in property value reported in Q3 2025, which was specifically attributed to revised valuation assumptions in Finland, illustrates that localized market pressures remain a tangible risk. If demand were to decrease significantly in the areas where Cibus's 262 Finnish properties are located, it could lead to vacancy rate increases, lower future rental rates, and declining asset values, adversely impacting the financial position of the group. 5.3. Dividend sustainability scrutiny. The sustainability of the attractive 5.9% dividend yield faces rigorous scrutiny from financial commentators due to the company's aggressive leverage metrics. Critics highlight the persistently high net LTV ratio between 55 and 59% and the net debt to EBITDA ratios above 9 times as key indicators that limit Cibus's financial flexibility. The high dividend yield currently offered by Cibus can be interpreted as a liquidity premium required by investors to compensate for the combined risks inherent in the high leverage and the substantial tenant concentration. While PFP management growth, 54% year-on-year, demonstrates ample cash flow to cover the existing dividend, the pressure from high debt service costs, particularly if interest rates moved unexpectedly higher despite hedging, creates a structural limitation on both accelerating dividend growth and rapid deleveraging. The maintenance of the dividend relies critically on the continued successful execution of accretive acquisitions and the realization of the projected sharp margin expansion to offset the high cost of debt servicing. V. Macroeconomic and real estate market context. 6.1. Nordic investment climate and stability. The Nordic region continues to assert its status as a robust and reliable safe haven for institutional real estate capital, a trend reinforced by global economic uncertainty. Investment volumes in the Nordic commercial real estate market experienced a surge in the first half of 2025, increasing by almost 40% compared to the same period the previous year. This growth significantly outpaced the European average. The momentum was particularly strong in Finland and Denmark, and Sweden also saw volumes 36% higher. Market pricing has generally been characterized by stability, though an improved financing environment is expected to act as a significant catalyst for transaction activity going forward. The strong institutional framework and unique concentration of knowledge institutions and financial capital, as evidenced by Stockholm and Copenhagen ranking first and second in the European Innovation Scoreboard 2025, further solidify the region's appeal for long-term real estate investment. 6.2. Grocery property yields and market dynamics. The specialized asset class targeted by Cibus remains one of the most sought-after segments in the Nordic real estate market. As of the first quarter of 2025, prime yields for grocery-anchored retail properties in Finland stood at 5.2%. Market dynamics are currently characterized by intense competition and yield compression, especially in Sweden and increasingly in Finland. Yield compression signifies rising asset values as investors are willing to accept lower entry yields due to the perceived stability of the cash flows. This competitive environment has resulted in market polarization, where demand is heavily concentrated on the most sought-after prime assets, the segment Cibus targets, while non-prime assets face upward yield pressure. While this market affirmation validates the high quality and defensive nature of Cibus's portfolio, it simultaneously raises the financial bar for future growth. The intensifying competition implies that the cost of future accretive acquisitions is increasing, potentially constraining the magnitude of future earnings capacity unless the company can continue to secure financing at exceptional market-leading rates. 6.3. Nordic retail consumption dynamics. The underlying consumer environment in the Nordics presents a mixed picture. Shoppers face renewed pressure in 2025 due to resurging inflation and tightening household budgets, leading to increased price sensitivity and more cautious spending behaviors expected to define the 2026 landscape. Consumers are exhibiting sharper price awareness and purchasing smaller baskets, with many worried about their personal finances. However, Cibus's focus on grocery and daily goods retail acts as a fundamental economic buffer against these trends. Since the assets are anchored by necessity-based retail, demand for the underlying services remains non-negotiable, ensuring stability in tenant revenue streams and consequently high occupancy and stable rental payments for Cibus. This non-cyclicality means that even if consumers become more cautious about non-essential purchases, the necessity retail tenants will retain their income stability, shielding Cibus from the broader retail sector's financial volatility. 7. Valuation analysis and investment conclusion. 7.1. Consensus valuation review. The overall consensus among financial analysts reflects strong market confidence in Cibus's strategy and execution. Based on a review of 4 analysts, the prevailing consensus rating is a buy, with 3 analysts recommending a buy and 1 recommending a hold. This strong alignment indicates conviction that the positive operational trajectory and financial engineering strengths will outweigh structural risks. Based on a current share price of approximately SEK 163.80, the average analyst price target is SEK 197.21. This projection implies a significant potential upside of 20.40% for investors, demonstrating the substantial optimism surrounding the company's near-term earnings potential. 7.2. Multiples and intrinsic value discrepancy. Cibus shares currently trade at a premium valuation compared to industry peers. The stock's price-to-earnings (PE) multiple of 19.1 times is notably higher than the Swedish sector average of 14.8 times. This premium is a forward-looking valuation driven by the aggressive forecast of 21% annual earnings growth anticipated over the next 3 years, a rate far exceeding both prior company performance and sector averages. However, traditional intrinsic valuation methods present a starkly different perspective. A discounted cash flow (DCF) model estimates the intrinsic fair value of Cibus shares at only SAK 118.96. This calculation suggests that the current share price of SAK 163.80 represents a theoretical overvaluation of approximately 37%. This substantial gap between intrinsic value and market price is explained by the market's aggressive pricing of the anticipated margin expansion. The DCF methodology, which typically applies discount rates reflective of high leverage, struggles to accurately capture the nonlinear value creation derived from Cibus's superior and highly hedged financial structure, especially the asymmetric risk profile provided by interest rate caps. The market is rationally rewarding the perceived certainty of superior future operational cash flow, effectively treating Cibus as a growth vehicle rather than a conventional stable REIT. The share price is also trading at a modest premium to the reported EPRA NRV of Euro 12.9 per share. 7.3. Final conclusion. The investment decision regarding Cibus Nordic Real Estate AB necessitates a calculated acceptance of structural financial risks in exchange for access to exceptional defensive cash flows and high growth potential. The company's successful use of high leverage has been highly accretive, driving strong income growth in Q3 25, 54% PFP management increase. Furthermore, its sophisticated debt management, resulting in 95% hedging and favorable asymmetric interest rate protection, substantially mitigates the most immediate threat posed by the high net LTV. The primary risk requiring continuous investor monitoring remains the acute tenant concentration, specifically the high reliance on Kesko, and the necessity for management to diversify this income base while sustaining its acquisition pipeline in a market experiencing yield compression. The current valuation premium is justifiable only under the strict condition that management achieves the projected dramatic profit margin expansion from 24.1% to 58.1% within the 3-year horizon. Failure to meet this aggressive execution standard or any operational difficulty experienced by a key anchor tenant would likely lead to a rapid derating of the stock. Investors are advised to focus on quarterly updates detailing the net debt to EBITDA trend and any progress in reducing the top tenant concentration ratio.